It's the year of the sheep in Asia, but will the sheep be gambling merrily over the hillsides, or will it be sat lethargically in the corner of a field? To debate this possibly dubious metaphor, we have two prominent economists from the region. In the upbeat corner, if I may, we have David Mann, who runs macro for Standard Chartered. And in the slightly more downbeat corner, we have Fred Neumann, head of economics at HSBC. Fred, if I can start with you. I mean, this region is still the fastest growing region in the world. What on earth is there to be gloomy about?
Well, it is the fastest growing region in a world that has slowed down quite dramatically, and even our growth rates here in Asia are down to the early 2000 levels. So it's no longer the good old days of the mid-2000s when the region was booming. The one thing that really worries us is that we have seen a big rise in debt, and it's very difficult to see that continue to rise. And that takes a lot of momentum out of these economies. It's hard to see an acceleration from here with debt levels already being that high.
Growth is actually quite reasonable, I think. I think what we should be actually not so pessimistic about is the fact that growth is in line with what we've seen on average for the last 15 years globally. I'm talking about first. It's been 3.5%. It averaged 3% in the 20 years in the run up to the year 2000. What's good about what's going on, and this is being ignored, is actually the very thing that people are miserable about. There's no unsustainable credit boom anywhere.
But what about some of this debt level that's built up in not only in China, but in other Asian economies, you know, in the household sector, in the corporate sector? I mean, as the US interest rate cycle turns and money presumably flows out of the region, could not some of these companies, households, economies be caught out?
Well, absolutely. During those years of ultra-loose policy in the West, we did for sure see a build-up of debt in certain sectors of certain markets. China's the most well-known one, but there's a few mitigating factors even in the case of China, in particular, that when people worry about the property market collapsing, they're ignoring the fact that actually household debt in China is incredibly low.
But nevertheless, growth has been driven by debt, and that debt has largely financed a construction bubble, especially in real estate, to some extent in infrastructure. And it's very difficult to see if we rein in debt growth, that overall GDP growth rate to continue. We think there has to be a gradual deflation of the construction bubble, and that will weigh on overall GDP growth.
Well, you mentioned deflation. I mean, do you see the risks of deflation coming to Asia? We've seen a number of central banks taking sort of preemptive moves, lowering interest rates.
We have seen dramatic falls in inflation across the region, and it's not just oil, it's also at the core level, and companies are complaining about lack of pricing power. And that combined with very high debt levels is obviously a toxic mix. You don't want to have deflation when debt levels are very high. And the risk now is that inflation continues to slide. And it's hard to see that turning around anytime soon.
There is a piece of good news also out there, and it is that even though, yes, we've gone through a credit boom and we're out the other end, credit growth now matches GDP growth on a quarterly basis. In fact, by our numbers, the debt to GDP ratio in aggregate for China has been flat since the middle of last year.
I'd like to turn, David, to Japan, if I may, which has been another big kind of swing factor with Abenomics. Is that all now running out of steam? I mean, we've now got inflation in Japan that's down to, I think, 0.2%. Is Abenomics over?
Well, I think Abenomics is and always only was arrow number one of the three. And the problem with having only one arrow out of the three is that you can easily break one arrow, whereas if you had all three, it would have been much harder to break it. It would have been much stronger. I don't think there's many other options left other than relying even more on arrow number one. And I think the way to think about this, actually how it could impact the rest of the region, is if we do see another ultra-aggressive outcome, let's say by April, from the Bank of Japan, and they go even more aggressive than their already incredibly aggressive policies, that could trigger another burst of yen weakness, which is not currently in focus right now. It's been more focused on euro weakness. If that happens, what we're worried about is people might start talking even more seriously about the idea of currencies elsewhere in the region, even including China, choosing to also weaken their currency. It's not our core scenario by any means, but that could be your transmission mechanism from G10 into Asia.
You're almost sounding like the pessimist there.
Yes.
Currency wars in Asia.
That's interesting. Our view is actually slightly more positive. If we do see yen weakness on Japan because the BOJ adds more liquidity, we think actually in the first instance it could be positive for emerging Asia because it does lead to capital outflows out of Japan at a time when the Fed might possibly hike interest rates.
Cheap oil prices has got to be good for Asia. Fred?
It's a differentiator within Asia, but one thing I would say is that Asia is often seen as being a big beneficiary of lower oil prices, and what puzzles us is that it hasn't shown up in the numbers yet.
Well, I think we're yet to see it show up. I mean, certainly there's some immediate benefits. For example, India running a current account surplus was unthinkable even a year ago, and here we are watching that. There are some that do have a negative impact, but I think it's probably overblown.
Industrial production is going sideways. The PMIs have, if anything, weakened since last summer. And to some extent, that's because some of the savings from lower oil are being saved rather than being spent.
The psychology is that it's just going to spike right back up again. It's temporary, so it is being saved for now. If it stays there longer, I think we will see even more of a good reason for cheer in the region.
Well, let's end it there. More time, says David. Not yet, says Fred. Thank you very much, both of you, for coming.
Thank you.